Hi everybody, if I tell you that one of the India's biggest 100x wealth creators didn't make softwares, didn't build social media but sold cement, would you believe me? That company is Shree Cement. In a sector most investors called cyclical, capital intensive and commodity, Shree Cement quietly became one of the most rewarding stocks in the Indian stock market. In the last 25 years, Shree has given a return of staggering 20% CAGR. So the question is, how a cement stock can go 100x? What did Shree Cement do differently? And how a value investor can spot this kind of opportunity before everyone else? In this video, we will break down the Shree Cement's story and then we'll put a framework that an investor can use to analyze cyclical business. Let's first understand the fundamentals of cement business. Cement is a commodity business where the product of one manufacturer is not different from the another, leading to low customer stickiness. When the product is similar across all the manufacturers, consumers tend to prefer the product that is priced lower. This results into the competition among the cement businesses primarily based on pricing. The major consumer industries of cement are housing and infrastructure, which themselves are cyclical in nature. These industries are subjected to boom and bust cycle where the demand increases in the upswing followed by the demand decline in the downswing. This in turn makes the demand for cement cyclical. Further, the simultaneous expansion projects of many companies bring the new capacities at the same time, which further increases the cyclicality. So the most effective way to compete in the business with no product differentiation, high competition and cyclicality is to become a low cost producer. And that is exactly what Shree Cement did. Economic Times estimated that around 2016, when the cost of production for cement for players like Ultratech, ACC and Ambuja ranges between 3,700 to 4,000 rupees per ton, it costed Shree Cement just about 2,684 rupees per ton. So now the question becomes, how did the Shree Cement produced cement at such a low cost, and what does it do to become a low cost producer? Well, a low cost advantage comes from higher operating efficiency. Shree Cement focuses on building its entire value chain a highly efficient system. Every key decisions from procurement, inbound of raw materials, operations to outbound of cement is backed by careful analysis and is executed with speed and precision. Now let's look at how Shree Cement built efficiency in three parts. First part, cement business is a capital intensive business. A 3,000 crore cement plant can generate a revenue of around 1,000 crore while EBITDA is 250 crores at 25% margin. This implies the ROCE of cement business is just at 7 to 8%. So the low cost of acquisition of assets is very crucial to generate a higher ROCE. Simultaneously, acquiring modern plants with latest technology and upgrading the older ones with speed becomes very crucial too. Shree Cement has very good project implementation capability. To put it in numbers, while it may take up to $100 to $110 per ton for other players to build their cement plant, Shree Cement can build their cement plant at just around $75 per ton. After extensive groundwork, market demand analysis and future ready design, Shree Cement builds their cement plant at low cost. And they do it with speed, because of which they have been able to grow 1.2 times the industry average. For the last 10 years, from FY15 to FY25, company's production capacity has grown at 9 to 10% CAGR. This strong competitive edge in terms of lower capex per ton provides Shree Cement a low cost advantage. Second part, Shree Cement gains significant competitive edge through strategies like raw material security, alternate fuels and optimizing raw material mix. These collectively result into substantial cost reduction. Let's look at it separately. First, captive limestone mines provide continuous supply, consistent quality and a low cost raw materials. CARE Ratings in its research report explicitly links Shree's competitive edge to its captive limestone mines. Second, power and fuel cost comprises almost 1/4 of total cost of production. Shree has established captive thermal power plants and is increasing its usage of renewable energy. This not only decreased the cost of production but also boosted significantly the green power mix. And third, Shree optimizes its raw material. Increasing usage of alternatives like fly ash, slag and synthetic gypsum reduces the clinker factor. Lower is the clinker factor, lower is the requirement of raw materials and fuel. All these interconnected strategies allow Shree to position itself as one of the lowest cost producers in the industry. And third and the last part, Shree Cement's continuous sales is built on last mile distribution network, availability of cement and brand trust. Shree Cement has a dealer base of more than 20,250 which generates roughly 75% of its revenue. Servicing its network through continuous availability of cement is of utmost importance to avoid a situation where a dealer is out of stock. Other services like marketing, branding and technical assistance improves customer satisfaction. Shree Cement does it all in such a way that its customer satisfaction score is 86% as reported in its annual report of FY24. All these tactics brings continuous demand for its product, which in turn increases the capacity utilization of the company. So, summarizing the above points, Shree Cement brings efficiency to its operations by A. Focusing on acquiring low cost assets with latest technology, B. Growing capacity with discipline, C. Bringing innovation in order to reduce cost of production, and D. Providing top-notch services to its customers. This allowed the company to grow at a rate of 12% CAGR for the last 10 years, while the industry grew only by 5.5% CAGR. Further, company accomplished this growth with zero net debt, which is unmatched by any other player in the industry. And that is the reason why Shree Cement has been a compounding machine for its investors despite operating in a commodity sector. Now coming to the most important part, which is the key lessons that we can take from this case study. Lesson number 1. Operating efficiency is of paramount in a highly competitive business. It is important to maintain cost leadership to achieve competitive edge and sustain margins even during the periods of downturn. It is also important to maintain a strong balance sheet, often in a net cash position, to successfully survive cyclicality in the long run. Fortune magazine itself notes that since 1955, around 1,800 companies have appeared on Fortune 500 list, which reflects that being big in size is not a protection. It is the efficiency that increases the chance of surviving in the long run. But also remember, efficiency alone does not bring the competitive advantage. For more details, look at our case study of Moser Baer. So, as an investor, we need to look out for efficiency, and a metric to look at it is the ROCE generation capability and the factors behind it. Lesson number 2. Time is a friend of good company and an enemy of a bad company. For the last 25 years, market cap of Shree Cement has grown at a rate of 20% on a compounded basis. And one of the reasons behind it is that the total addressable market opportunity for the company was very large, and the company capitalized on that opportunity by expanding its capacity. This led the sales of the company to grow from 900 crores in FY 2000 to over 20,000 crores in FY 25. Net profit grew from 15 crores in FY 2000 to over 2,400 crores in FY 25. So large total addressable market is necessary for long-term investors. And lesson number 3. While other big cement companies are on acquisition spree, Shree Cement focuses on organic growth. It is the management that takes the capital allocation decision. Management of Shree Cement focuses on profitable growth rather than the growth itself. Investors need to join the management which does not just copy other management but think critically to take rational decisions. Further, strong promoter holdings with strong focus on governance build investor trust. So, a simple framework to analyze any commodity business is: first, does the company has real cost efficiency? Look out for at least past 10 years of data to find it out. Compare its cost of production, margin levels and ROCE behavior with its peers. Second, is management allocating capital efficiently? Look out for the debt levels that the business employ and how comfortable the business is in servicing that debt. And third, does the business has huge reinvestment opportunity? Look at how the business has grown in the last 10 years and what is the management's vision for the future. Use this framework to analyze your next company. And that brings me to the end of this video. I hope this video has provided some value to you. If this video has provided some value, please like this video and subscribe to this channel for more such investment case studies. Thank you so much for watching. I will see you in the next video.